Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah, and over the next 25 minutes, we'll talk all about mutual funds. Specific pointers, though, this time around, we'll talk about three key categories. One, small cap funds, where there is a study done by Sage One Investors, which shows that when you look at the NSE 500, the top 100, 101 to 250, all of those pockets appear overvalued. The small caps, still as a pocket, are not beyond their peak valuation. That's part one. So what are the small cap funds that one can still invest in? What is a good idea? So that is part one. Gold has been on a tear. This morning on the trade setup, we were talking about how gold prices have risen and they're knocking on the doors of past 1900 and looks set for more. So how is it that you can take advantage of it through the mutual fund route? We'll try and talk about that. And last but not the least, something that everybody plans in the months of January, February, and March. Are we leaving it a bit too late and therefore completely out of turn? No reason to do it this week, but we still ask our advisors about the best tax saving funds to invest in so that you can start your SIPs now so that it saves you the last minute rush later on. Our two experts are with us, Gurmeet, Chadha, Amol, Joshi. Gentlemen, both of you, thanks so much for joining in. Can we just start off with the conversation around small cap, because they seem to be so much in the limelight, and either of you can start. Gurmeet, let's start with you. What's your sense about whether you are recommending small cap funds to your clients? Why or why not? And then, of course, we'll get to the funds themselves as well.
So, hi, Neeraj. Thanks for having me. I think it's an interesting discussion considering that we've seen small cap funds post 100% plus returns last 1 year. And we saw that in 2017 when people entered, and we saw a fall. Small cap, should be part of the portfolio. There is no standard rule, but essentially for moderate to high risk investors, a standard formula which we worked when we were in B schools for 40, 40, 20, right? 40 large cap and index, 40 multi cap, and 20 between. But as I said, there is no standard formula. And the returns, the nature of the beast is that the returns are lumpy and can really, so it should be there in the portfolio. The attribution analysis has to be spot on. The choice of fund has to be, spot on. I was looking at the returns, the 10-year returns, the index is 10%. The best performing fund is 23%. And the worst performing fund is in single digit. So a dispersion of 4-5%, which we see in large cap, here the dispersion could be 15-20% over long periods, and liquidity and the way the fund has managed various cycles. So it's easy to get carried away, right? Seeing 1 year returns 100%, but you should stick with guys who've seen bad cycles. COVID, 2008, 2018 correction, and draw fact that how did they manage. So a lot of things must go into consideration, but definitely should be in the portfolio.
Must have in your portfolios, even at the current levels, is what Gurmeet is saying. Amol, does your view differ there, or would you believe small cap funds are an integral part of the portfolio, even at the current valuations?
Well, Neeraj, I believe that small cap funds essentially should be part of your portfolio if you have horizon of 7 to 10 years or more. As Gurmeet rightly said, the returns are lumpy. He also alluded to 2018. So we all remember during 2018 budget, when the equity LTCG from 0, when it was brought back to 10%, you had consistent 1.5, 2 years of bear market in mid caps and small caps. And small caps really took the brunt of it. Some of the stocks were down between 40 to 60%. And from those levels, we have now seen more than 100% of the recovery. If you can withstand this kind of volatility, if you truly have a conviction that your investment horizon is 7 to 10 years, and hence couple of years, 2, 3, even more than 3 years of underperformance is not going to shake your conviction, only then you should be part of the small cap investor group. That's number one. Do we suggest investors? Yes, of course. For somebody who is planning for a long-term investment goal, financial goal, for those people, small cap could be a part of asset allocation within the equity category.
Point well taken. So then, Amol, let me ask you, what are the funds that at the current valuations, I would request you to keep in mind, one, that the valuations have moved up, even though we are still as an index undervalued compared to the medians for the large caps and the mid caps maybe. So looking at the fact that the current valuation, and the hypothesis is that the investor who is willing to put in the money right now is willing to stay invested for the medium term and is willing to take a little bit of risk, Amol. So with that in mind, what are the funds that you're recommending, or what is the fund that you're recommending and why?
Right. In the previous part, again, we heard about the dispersion, high dispersion of returns. There is high dispersion between the AUM also, just to use the word. So we have small cap funds from a 200, 500 crore AUM all the way to 10,000, 13,000 crore AUM. So in a small cap fund that has a 13,000 crore, you are not going to be able to maintain it just by 20, 30 or 40 stocks. Most of the small cap funds have in excess of 60, 70 or sometimes 90 stocks as well. In a wide choice of couple of dozens of funds, I would go with ICICI Prudential Small Cap Fund. It's relatively a smaller fund, about 2,000, 2,100 crores, managed by Shankaran Naren. And this fund has been, actively investing into you can call it opening up trade. What I mean to say by that is the fund is currently overweight into construction, real estate, entertainment industry. This fund has done the sectoral allocation right for over last 1 year, and it forms a part of top quartile performance in last 1 year, given the sectoral allocation and the value theme that they are able to play over here. Now, most of the times we don't go by returns alone. The way we spoke just now, we are looking at sectoral allocation also. Now, when you go for a small cap fund, you really want to know what kind of small cap allocation is there in the fund. Many of the small cap funds, especially the larger ones, have tried to keep the small cap allocation to the bare minimum of 65%, which is the regulatory mandate. And remaining 35% to manage redemptions or to manage volatility, you have into majorly large cap. However, this is one fund which has in excess of 84, 85% in small cap. So what I would call it true to label. All of them are true to label after scheme categorization, but this one more so.
Okay. So, well, Amol, thanks for that. And thanks for the rationale as well. Gurmeet, same question to you really. What is the fund, or what are the 1 or 2 funds that you recommend? Why? And frankly, there could be 8, 9 funds, Gurmeet, that could be very good, but we don't have the leeway to speak about so many. So let's restrict to 1 or 2.
Yeah. So we have a focus, is Neeraj, as you rightly pointed out, and I agree with most points of Amol on AUM. I think the second most aspect, so, through small cap and Naren personally managing it, is obviously an additional incentive to good look for it. I think what I like in this category is 2, which is SBI, Axis, and BSP. I'll discover SBI small cap. Reason being, it has the longest standing track record on consistency and on managing cycles. I like the fund manager for his ability to moderate flows when he thinks that the valuations are high. So currently, you can only put 25,000 rupees per PAN. Tells you that the fund manager is not greedy for flows, and it has an SIP book of 280 crores, Neeraj. It helps you manage redemption pressure without taking, liquidity can be an issue in down cycle, and in panic you can see large. So a good SIP book is one. Fund manager experience is one. Also, the representation of sectors, which Amol partially alluded to. You have 38 odd sectors which are not completely represented in Nifty, right? So chemical, textiles, some of the auto ancillary. Yeah. So there are so many of them, and I think better representation, better attribution analysis is what I like. SBI small cap, if you see, they if you go for the holdings, very good stock picking. They were very early into Dixon, got into cement early with JK Cement, got some of the good pharma, small and mid cap names, and also you have to be honest about the mistakes also. Because it's the nature of the asset class, right? So it's good to accept and move out of that. So I like that agility. I like the sectoral and presentation of the theme in the fund. And as I said, it's a fantastic track record. 13% over benchmark on a 10-year basis is significant alpha. Last point, Neeraj, low beta. So it falls lesser than the market, 0.86 to be precise.
Okay, so thank you for that. In very succinctly, 30 seconds each of you, Gurmeet, what's the risk to this category for anybody investing in a fund? Again, long-term horizon, everything there. Yeah, but what's the risk? 30 seconds.
Large drawdown, Neeraj. You can see up 72% correction in 2008, 40% correction. It falls more than Nifty in down cycle. So you have to be prepared for it. And prefer SIP STP route. That's the best way to play this category over long term.
Okay, so yeah, don't put lump sum. I think that's the limited point that Gurmeet is trying to make, and be prepared for drawdowns. It could well happen. In fact, celebrate drawdowns because you could actually buy more of that fund at a lower price. Amol, very quickly, 30 seconds. The risk to This fund or the category, whatever.
See, honestly, when we come down to brass tacks, we know that the only thing that really rattles investors and especially retail investors so is the fall into returns. So as again Gurmeet rightly said, that you have seen fall anywhere between 40% to 60%, sometimes more. If you cannot handle that, then the entire thesis of investing into small cap goes out of the window. You'll probably sell it at a loss and move out and never come back to small caps or equity again. So I would say the biggest risk is being prepared for the large drawdowns, being also prepared for extended period of underperformance running into several years. The most recent in our memory, we can say that 2.5 years is the kind of extent of longer periods of underperformance. So these two from my side.
Yeah, no, and that kind of encompasses all. I don't know if it's only me, but I think Amol's frame seems to have been frozen. But anyways, we'll try and get that sorted. Yeah, now I think I could see Amol move around. Anyways, yeah, perfect. But we got your answer, Amol. Thanks. Now, the second category, Amol, this I want to start with you, and let's talk about the gold funds, right? I mean, or gold, right? Now, the most common thing that everybody says is go out and buy a gold ETF, and a lot of people have done that, and maybe this is the right advice too. I want to understand the mutual fund way. Aside of ETFs, what else can a mutual fund investor do to take advantage of the rise in gold prices? Again, there is no saying that this is how gold prices will continue to behave.
Sure.
Nevertheless, what's your advice?
So Neeraj, in my opinion, this is a very interesting question, and there is more than one way that you can take benefit, or rather take exposure, I would say, in an asset allocation framework. You can take exposure to gold. So first and foremost, as you mentioned, ETFs, a lot of people have done it. Probably the biggest attraction of ETFs is the low cost. Now, if we go beyond low cost, if you go to retail investor, how retail invests, how most of the investors invest, they want to essentially take exposure via SIPs. Many of the brokers still, the brick and mortar, the older ones, still do not offer the SIP facility. If you want to take exposure to gold via SIPs, you can simply go towards gold saving fund. Gold saving fund is nothing but a mutual fund which invests into gold ETFs. So here it is slightly costlier, of course, because it is not ETF structure. So other than ETF, you can look at gold savings fund, number one. Number two, why I mentioned this is very interesting question, because although this is mutual fund show, we can talk about something that truly benefits the clients. So something like sovereign gold bond, this is really beneficial in terms of, there are various advantages. Any kind of product, financial product, if you look at, there are costs. Sovereign gold bond is probably the only product that you can think of which has no cost. On the top of it, it gives you 2.5% annual interest. And after everything is said and done, it's an 8-year product. If you hold to maturity or a 5-year, 6-year, 7-year, 8-year horizon, you do not have capital gains also. So no expense ratio, 2.5% annual interest, and you get gold pricing at the redemption, which is completely tax-free. Now, this is second way. And as I said, there are more than one ways of taking exposure to this theme. The third way is something which is thematic. Many of the times we have discussed on this very show about themes or sectors. You can invest into, when gold prices rise, obviously, it does well. Gold mining companies also do well. So I would say that you can take exposure to gold mining companies. Now, you don't have a hell of a lot of gold mining companies in India. Most of the companies are international. You can take exposure to something like DSP, World Gold Mining Fund, which invests into gold mining companies. But mind you, there is not just the risk of gold prices, there is associated equity risk as well. The companies are leveraged. If there were to be a fall in the prices of equity crash, so to speak, then even when the gold prices are robust, you would probably see a fall in prices of these shares, and hence NAV will take a hit. So these are three options in addition to gold ETFs, what you can look at.
Because this gold mining companies is a separate conversation altogether, by the way. But yeah, Amol's point is well taken, that in a product like the DSP Gold Fund, World Gold Fund, could be an option. Just keep in mind, if you're investing in that fund, please go out and study that very, very carefully, simply because the fund's NAV will not move up just because gold prices have moved up. In fact, at times it's negatively correlated. So please keep that at the back of your mind. Gurmeet, same question to you. Aside of ETFs, which is the most commonly used thing, and Amol highlighted SGBs, but I mean, not essentially a mutual fund product, but there are liquidity issues notwithstanding, it's probably a great product. But what's your sense about a mutual fund way to play this?
So, Neeraj, I think the gold FOF, gold saving fund is a good way to play it. You can't really do SIPs or long-term allocations through ETF. Plus, there are liquidity issues. We've seen that, the NAV really having a large tracking error because of market making issues. So one is the gold saving fund, and typically you should divide it into two parts. One is you want to play gold tactically as a hedge against a black swan event, right? And gold does well. So 2015-19 almost flat returns. And we've seen last year, we've seen 2008 to 11 very good returns post global financial crisis. So the Nifty correlation of gold is 0.05, right? So it offers you very low or almost like negative correlation. So divide the tactical into a savings fund or ETF if the allocation is very large. Divide the long-term thing into, as Amol made, sovereign gold funds. We've had 10 tranches, no capital gain after 8 years, gives you 2.5% interest. And you can keep averaging out because of various tranches. Gold mining fund is not gold. That's an equity allocation as a derivative of gold prices. So don't confuse it with gold. We are doing asset allocation. That is still equity, in my opinion.
No, and it is a good clarification that you made out there, Gurmeet, that it is essentially an equity call that you're taking, because at times it moves in completely converse way to gold. Just wondering, what's the risk to so just to recount this, actually, sorry, I just want to get, so aside of the gold ETFs and sovereign gold bonds, which are not essentially a mutual fund product, there are very few mutual fund options to play gold price rise, right?
No, they are enough, Neeraj, now. So I mean, Nippon was a pioneer in getting into a gold saving fund. We have Kotak, SBI, Birla, almost all large fund houses, Access have gold saving fund. Go for the one with the lowest tracking error. Of late, the funds are, have spent time, so I think they are also evolving. And the tracking error so far has been contained to less than 1%, which is also includes some expense. Might be mindful of the expense, because if the expense is very high, tracking error would be high. So be mindful of the expense ratio, and and be prepared that this is a hedge. The returns again in this could be, you can have low periods of flat returns. But this is a hedge in case something goes wrong. And it may happen to crypto, may happen to anything. It's a hedge against that, and also maybe some hedge against the currency fluctuations.
Yeah, point well taken. Okay, I seem to have lost Amol, but anyways, I want to start off this third category with you, Gurmeet, and we'll probably try and get Amol back when he joins in. But Gurmeet, to you, and tax saving funds, it's such an important category, and usually reserved for conversation around Jan, Feb, March, wherein the shit hits the roof, as they say. But there's very little time. But let's try and do that now. So viewers, if you don't have a tax saving fund, and if you don't have other options, I mean, outside of your EPF, employee provident fund, but if you're a businessman, then you don't have that also, then start it now, right? And presuming that you don't have PPF, etc., and all of that. So with all of those assumptions, what would you advise about tax saving funds?
So, Neeraj, personally, I do SIP of the entire 1.5 L, and I think the reason is you have to give more time for compounding to happen. Even in a PPF, you get the minimum interest between 5th and the end of the month. So if you add to your PPF after 5th, you miss out on the month. So it's simple thing is allow investments more time, gives you more control over cash flows. And mind you, this is not an expense which you have to comply because of ATC. It's an investment. Don't make it so much pressure on you that you just go for it because you're left with very few choices. Allow the cash flow planning and discipline to work out. Allow the compounding to work out. And don't think of it as a 3-year investment. The lock-in is 3 years, right? And all the more reason you have to be very careful, because you can't do anything if you get your choice of tax saver wrong. So plan well, and this is part of your core allocation. This is something which will go into your retirement kitty. So don't think of it as a 3-year March ending phenomenon.
That's actually pretty sane advice. Amol, what do you tell your clients when it comes to tax saving mutual funds? Do an SIP every month? Is that a good thing? And is therefore right now a good time as any to start? And any advantages, disadvantages, Amol?
So not just the tax saver, but for investments, no better day to start than today. So we all have said that many number of times, and we take every single opportunity that we can get to reiterate this. So number one. Number two, obviously, SIP always is a good way to take exposure to any asset class, especially so in equities, simply because, and it needs, it has been repeated number of times, but rupee cost averaging is something that is a very good kind of benefit of SIPs that you do get. Anytime when you want to invest, and like you said, don't just, all of us should not just wake up between Jan to March quarter and just dump 1.5 lakh rupee into the first person who comes to us with any fund or any product that will just give us a receipt in 24 hours and just be done with it. So don't do that. If you plan, and as Gurmeet rightly said, this is lock-in is 3 years, but funds can stay for as long as you want. And since there is a lock-in, this certainly, again, just like small cap funds, this can be looked at as a long-term investment horizon. You also asked about advantages and disadvantages. In your opening, in the question part, you also mentioned about we are keeping aside PPF or Employees Provident Fund contribution. Now, the key difference between this, all those are fixed income products. And ELSS, equity tax saver mutual fund, is obviously an equity product. So disadvantages, you will not get consistently 7 or 8 or 12 or 14% return. Be prepared to look at some kind of volatility, including the capital, going down. That's the disadvantage, I would say. The advantage is it is one of the lowest lock-in products. You have tax saving FDs, the lock-in is 5 years. You have other tax saving options, especially PPF and EPF. Those are into multiple years, 15 years and probably longer than that for your EPF. So the advantage is low lock-in. Other than PPF, you also have a taxation that is very, very friendly compared to tax saving FD of 5 years. The interest will get added to your income. However, here equity taxation applies. So LTCG just 10%. So many advantages, but SIP, growth over and above fixed income and tax advantage. These are major advantages in my opinion.
So then what's the fund, Amol, which is a good tax saving fund that, or a couple of funds that you recommend?
Right. So in the market, we have seen rotation in last 1 year. The growth funds or so-called growth sectors are currently not really the flavor. What is working is value. That's why during small cap funds also, we spoke about how that fund has taken the sectoral calls right. We also spoke about what is the kind of large, mid and small cap allocation that is there in the funds. Now, this is one of the important parameters that we look at even while choosing the ELSS fund. So here I like something called as IDFC Tax Advantage Fund. It is a multi-cap fund. Many of, again, here also there are funds of 10,000, 20,000 crore sizes as well. And just by the nature of the beast, just by nature of 20,000 crores AUM, you have large part going into the large cap sector. Now, this is essentially a mid-cap and, not mid-cap, I'm sorry. This is essentially a multi-cap fund. You have about 50-51% into large cap, and remaining 45 to 50% into mid and small caps. And that's why this fund has really done well over last 1 year, last 5 year. Last 1 year category returns are about 75-77%. This fund has delivered 102%. So like you mentioned, small cap has delivered 100% in 1 year. This is one fund which has 51% of large cap and still it's right up there. So we like the multi-cap orientation. We like that there is a sizable allocation to mid and small caps, which has done well. We also like this fund also has been able to get its sectoral calls right. And currently they are overweight into commodities, cement and building material. All of these sectors. So all of these points to better days for this fund going ahead as well.
Thanks, Amol. Gurmeet, what about you? I mean, within this, I mean, because you mentioned that it's a really long-term thing, hold till eternity, so to say. What do you like and why?
So Neeraj, I prefer consistency as always in this category because this is one part of money which you are actually comparing with more conservative options like PPFs and etc. So by design I prefer and I don't think that a lot of clients we speak to we make more exposure to tax saver because it also forces you to at least stay for 3 years and don't react. So we like two funds in this. We like the Mirai Asset Tax Saver. It's done phenomenally well. Great blend of growth and value. 70% large cap, 30% mid and small caps. So if you see the holding, the top 10 stocks, you will find the regular ones, which are the banks, the Infosys and the Reliance of the world. And then the good they were early into Tata Steel. They got into some good value themes. They got into chemicals on time. So and if you see the last 5-year CAGR, it's about 21% plus. So it's generated phenomenal alpha and with pretty consistency. I mean, it's been pretty consistent. The other one which we like is Axis Long Term Equity. more concentrated in nature. So the top 10 stocks make up 63% of the portfolio, almost 80% large cap. And it's a straight line. If you plot 3-year, 5-year, 7, 8, 10 return, it basically is 14 to 16%. So I like that consistency. I like that, a sense of calmness, because I also think it's as much about customer experience in the category as about, the overall returns.
Yeah, man, this was informative in more ways than one. Thank you so much, both of you, for joining in and giving our viewers a sense of what to do with some of these fairly newsy and fairly important categories. Gurmeet, Amol, really appreciate your time.
Always a pleasure, Neeraj. Thank you.
Thank you. Thank you. And viewers, thanks for tuning in. We're run out of time completely. Thanks for tuning into this leg of the Mutual Fund Show.